you scale horizontally, what you need to be doing is figuring out how to create a pricing advantage for all of your offerings so that as people come in and buy, they're paying, not only are they, not that they're paying more, but they're happily paying you more because you're giving them enormous value.
Hello guys, what's going on? Arman here, and today I'm with Martin Priest. He helps businesses use finance to dominate their market. And today I wanted to bring you a very interesting and cool topic. It's called Why Brick and Mortar Beats Digital Assets. And I have here Martin to tell us all about it. How are you doing today, Martin?
Doing great, thank you.
Awesome. So I wanted the audience to know a little bit about your background, and then we can dive into specific questions I have for you regarding this topic.
Sure. Well, I spent about 20 years in finance on Wall Street. I got to structure some enormous deals and do some interesting things and meet some amazing people working with large institutional clients, as well as, some of the more nimble, savvy investors that you can imagine, hedge funds, private equity, venture capital type stuff over the years. And over the last few years, I've been in private practice where I'm spending more and more time helping small to mid-sized businesses solve their financial problems, specifically to drive revenue and ultimately turn their financial weakness into a strength so that they can beat their competitors.
Absolutely. So before that, you said what the thing that matters to me the most is billion-dollar transactions, right? You've been involved in billion-dollar transactions. I mean, I'm a marketer. We gotta have that on the front of the video because that's a very cool part.
Sure. One of the more interesting things is, I got to work on some billion-dollar transactions at various points in the market, where I was able to help us make, some great money along the way, and really, it's kind of numbing when you're working on like a trading floor to think like, oh, this was $1 billion, this is 100 million, this is 50 million, this is 100 million. You throw around these big numbers and like it sounds almost like made up fantasy land, like a cartoon character, like, I did $11 billion, whatever. But the reality is you add a couple of zeros and as long as you can sleep at night, it's the exact same transaction.
Wow. Powerful. So tell us a little bit about your theory of why brick and mortar beats digital assets. We are in a situation or phase right now, NFTs, crypto, that market is hot. And all of a sudden we are hearing this almost like totally opposite story where you're saying that, brick and mortar beats, all these things going on. So tell us a bit more about that.
Well, first of all, brick and mortar, to define it, I'm talking about, what most people call like the real economy, right? You have retail, you have services, you have construction. These are businesses that people go to work at, people walk into, it could be real estate, in fact, or whatever. And look, everyone, for example, retail, everyone knows retail is dead. It's going through the, retail apocalypse and all that sort of stuff. Well, the reality is they're not. They're going through an evolution, and depending upon how nimble they are, brick and mortar businesses have an inherent structural advantage over digital businesses and digital assets.
Why? We talked about earlier, you brought an amazing example. I want you to tell the audience.
Okay, so there's three reasons. The first of which is the cost structure is very different, right? Every business, as you know, has ups and downs in terms of its utilization, right? How many of us employ somebody who's sitting sometimes in our store or in our office and they're not really doing anything, right? They're surfing the web or whatever. There's downtime implicit within that. that is a sunk cost that brick and mortar has to pay. Okay. But in order to, what we're seeing now is digital businesses, unless they're enormously scaled, they also have the same problem. So what's interesting is a brick and mortar business actually, as they digitize, or as they're doing stuff that, like grocery stores are doing curbside pickup now and things like that. That is them. That didn't cost them anything, right? As they digitize, literally what they're doing is they're recovering their sunk costs. So if you think about it, in order for, and grocery store is a very simple example, but we'll just to make it easier. In order for a grocery store to deliver a digital experience or a digital convenience experience, go on an app, pick out your stuff and drive by, pick it up, and voila, they literally are recovering costs. They're recovering the cost of the labor that was sitting on its hands already. They're recovering the cost of the real estate that they were sitting on already. So in effect, their cost structure is negative. Mm-hmm. Meanwhile, the digital competitor has to maintain that cost structure. They don't have a sunk cost that they're trying to recover. So they have a higher cost structure. And as a result, everyone likes to think that digital has a lower cost structure because you put up a website or whatever. But in order to fulfill it, in order to satisfy the customer, in order to warehouse the inventory or whatever, you are like, you're basically, unless you've achieved scale, you're sitting on a lot of sunk costs that you cannot recover because you don't have the retail channel, the physical retail channel. So all of these businesses, as we're looking at brick and mortar versus digital, they're a lot, first of all, they've just got a much better cost structure. And I know that's counterintuitive because everyone thinks that websites are cheaper. But if you really think about it, you're comparing tangible cost versus sunk cost. And, that's an infinite advantage. The second reason that brick and mortar wins is they have diversification, right, of assets, of cash flows, and they can monetize their customer value much higher. Everyone talks about like sales funnels and online this and upsells and on Amazon and all sorts of stuff, and that's great. But at a certain point, your catalog is so narrow that unless, again, you've achieved scale in a digital context, the brick and mortar business, let's say it's a construction guy, right? I'm doing your roof, but also, by the way, I can do your fence, right? You can't do that on digital as easily. So the service aspect of it, the physical aspect of brick and mortar, enables you to customize your offering and push a bigger catalog directly into the customer much better than kind of guessing on an actuarial basis like you do in digital. And the third reason is, quite frankly, people understand you better, right? When you're a digital, and that, us dinosaurs, right? We're going to say, it's just that I don't understand it or whatever. Fine, I don't understand it. But you know who else doesn't understand a digital business very easily?
Who?
Your banker.
Interesting.
Go try and get a loan against a digital business, right? The multiples on that, on the valuation of a digital business, are closer to 1 to 2 times, maybe 3 times if you really stretch it out. But if you don't have a physical business, you're not going to be able to achieve those multiples. Meanwhile, a well-scaled physical business, brick and mortar business, can get 3, 5, 8, 10 times equity valuations. So you have an inherent audience advantage. And while, everyone wants to talk about the digital unicorn and all this sort of stuff, the reality is most small businesses that are digital are grotesquely undercapitalized, don't have enough revenue, and therefore don't have a strong enough investor audience for them to facilitate their growth. Because, ultimately you have to grow organically and inorganically. And inorganic growth for a digital company is almost impossible. Meanwhile, and that has to do with like barriers to entry issues and multiples and all that sort of stuff. But with a brick and mortar business, there really is a lot more that you could do in terms of leveraging and creating this. So, everyone wants to say that like digital beat retail or digital beat brick and mortar. And to a certain extent, they were, because they were moving faster. But the pandemic has taught us that once those tangible resources and those, greater financial resources can be leveraged, they just come in and smash you. So that's why you look at like Amazon, right? They've achieved enormous physical scale. They have fulfillment, they have all that sort of stuff, but also, they bought Whole Foods. They're experimenting with convenience stores, right? They invested dramatically in their own physical delivery infrastructure, right? The Amazon wagons and stuff like that. That is them establishing a physical brick and mortar presence, because that gives them the leverage to dominate their market and become a price maker as opposed to a price taker. So, and there's some other reasons too, but I feel like that's enough for the middle of the night.
Yeah, absolutely. And so with that information, I'm a brick and mortar guy, and I want to grow.
Mm-hmm.
I'm talking to you. First of all, what are the typical mistakes that you see that they're doing, and what are some tips for people willing to invest in brick and mortar and grow?
Oh, those are two big questions. Let's start with, what are the typical mistakes we're seeing brick and mortar make?
Yeah.
One, there's some are still admittedly stuck in a brick and mortar mode, so they haven't digitized their marketing, or they haven't digitized their fulfillment or their operations necessarily, and they're at a competitive disadvantage to the companies that have digitized it. That makes sense, right? I mean, but an amazing example, Sears blew themselves up because they couldn't run their balance sheet properly, and they didn't figure out how to have a web presence. Interesting fact, Macy's was even though they filed for bankruptcy, they were able to survive in part because for the last several years, Macy's was like the 9th most visited website in America, right? Wow. So that's a very powerful foothold. And what Macy's did was they used their locations, their physical locations, as a way, just like I was talking about, to recapture some of their sunk costs and fulfill.
Mm-hmm.
So,
go a bit deeper. What did they do in that specific case with Macy's? Do you know?
So what they did was they gave people, they put up a website. They've got their locations, and the inventory was the same, right? But instead of having a warehouse, they would say, well, our sales associates in the location nearest you, you can come pick it up from them, or they'll throw it in a box and ship it to and have it sent over to your house. Right? So instead of having an Amazon style warehouse that people are all frightened of, Macy's leveraged the sales force that they had, and the real estate that they had, and the inventory that they had. And guess when they were doing most of the fulfillment? They were doing it in the middle of the weekday, when most of the retail shoppers are not there.
Wow.
So they took low utilization staff times to fulfill peak shopping times at night.
Wow, powerful.
Right. So that has the effect of smoothing out their cost structure while at the same time maintaining their revenue. Now, does Macy's have a lot more to do? Absolutely. But I can tell you this: if Macy's was properly managed and properly funded, I think they could beat the crud out of pretty much any t-shirt vendor or online, like, who would you rather invest in? Like a niche, I don't know. And I know there's like all sorts, and I'm not like a shopping person at
Etsy,
all, but like
Etsy type of stuff.
Well, not Etsy's, because that's a marketplace, right? But let's say like Stitched, or like one of those like rent the wardrobe or rent the Rent the Runway? Is that a thing?
Not very familiar with this topic either. Yeah.
Yeah, okay. So when so we should agree that you and I should not talk about clothes.
Yeah.
But
Yeah.
the reality is, you can have a different business model. And let's say that you've discovered, like, I think Rent the Runway is the one that did a recurring clothing rental service.
Mhm.
If
Okay.
that succeeds, two things are going to happen. Macy's or some giant retailer is going to look at that and say, wow, that's great. But I got a better idea. We'll do it ourselves. So the option one is they either just rip you off, or two, they buy you. And that's exactly what Walmart did with Jet.com, right? Jet.com, Walmart paid $5 billion for Jet.com,
Wow.
and they wrote it off. Why? They shut down the website. Why? Because they took all the employees and all the intellectual property from Jet.com, and it was basically a $5 billion acqui-hire so that Walmart.com could be more competitive. And you're already starting to see enormous results with, like, the Walmart marketplace and all that sort of stuff. So the capital that the physical world has is much better than the digital, because, well, it's digital versus physical. Similarly, in the tech space, right? Dell can buy anything they want. Hewlett Packard can buy anything they want. They're not going to allow a virtual competitor or digital competitor to eat their lunch. They're going to catch and kill them or acqui-hire them. So there's all sorts of reasons that I would say ultimately you can see a small pop on a digital asset, but in terms of long-term sustained growth, it's got to be real world.
Yeah.
Yes. Do I think I can double my money in 3 years by owning some random little startup? Sure. That's fine. But the real money is when I'm able to make 7, 8, 10, 14% a year for the next 20 years. And so
Yeah.
the long duration, high yield opportunities are still in the physical world by virtue of the fact that they actually have the resources and a lower cost structure.
Absolutely. So we discussed errors, and then the next kind of part was tips. So I'm thinking of a lot of people right now in my mind that I've interacted with. What can I do to, and you brought some examples, for example, with Walmart and stuff like that, Macy's, but what can I do to grow my brick and mortar? What are the next steps for me?
So the brick and mortar business is it really is industry specific, but broadly speaking, let's say that you can grow horizontally or vertically. Horizontal would mean you are able to grow your catalog of offerings, right? That would mean that you should be able to offer more services, more goods, more products, and also reposition them in a way so that you have more pricing power. So, for example, you don't like there's an economic reality
Mhm.
that if you're competing on price, you're in a race to the bottom. If you scale horizontally, what you need to be doing is figuring out how to create a pricing advantage for all of your offerings so that as people come in and buy, they're paying, not only are they, not that they're paying more, but they're happily paying you more because you're giving them enormous value. So the great example would be, you own a dry cleaner. Well, we'll charge you more. We'll charge you a little bit more so that we can do dry cleaning in your laundry, and we'll walk your dog, or whatever it is, right? Or we'll clean your carpets or something, right? Bundling all that sort of stuff out is a great way to handle it. And so you want to have in your market a pretty robust catalog. Then there's the vertical. That's the vertical, and then there's the horizontal approach, and that is about trying to figure out how to uh, enter into different markets. And that could be, if you're a local business, how do I get into the next locality, right? So that I can create scale in a contiguous place and create distribution density. If you're a national market, how do we sell sell different things to the same people? So I don't know, dog walking services again, and travel services, right? Or like a home hosting, but while you travel services. Figuring out who the customers are and then what do they want. The easiest way to do that is first just ask them what they want, right? And then once you know what they want, ask them who they already get that from. And don't try to get on the startup cycle. That's the greatest danger that we're really dealing with. Avoid always being in the startup mode in your business. Everyone has to start at the beginning. But at a certain point, you need to be ebbing towards an investor and thinking more strategically, as opposed to dealing with the tactical nightmare of startups.
Can you define startup mode a little bit, like for the people that don't?
Sure. Like how many times have we figured out that we need to do something by ourselves or do something, and reinvent the wheel, if you will, right? Armand, in your business, you need to figure out how to run your bookkeeping better, right? Why are you trying? So you go buy 3 books at Barnes and Noble and you read about bookkeeping and you scratch your head and all this sort of stuff. Meanwhile, there's a freaking bookkeeping virtuoso in Kentucky that's the nicest lady I've ever met, who will do it for $800 or $900 a month, right? Is that a good, so if there's a good reason to reinvent the wheel, and that is if you really do have a better wheel. But if there's a better wheel, if there's a really good wheel already out there and you don't have the expertise to build a better wheel, buy that wheel, rent that wheel, lease that wheel, swap that wheel, come up with a deal where that wheel becomes yours. It's just a lot faster. It's a lot easier, less stressful. Most entrepreneurs sell their time way too inexpensively by doing crap that someone else can do. And I know this because, I see it in lots of balance sheets all the time, and regrettably, I do it myself too. I get upset with myself. So yeah, you've got to have a number in your head. My time is worth X number of dollars per hour. Well, if I can get somebody to, do that for me for less than that amount, we should have them do that. And that's ultimately how you buy your time freedom. There are partners in law firms that bill $1,000 an hour, and they only work 4 or 5 hours a day, and that's okay because they're using their time to run the other parts of the law firm and get more than $1,000 an hour. So you need to think of yourself almost as if there are all sorts of demands on your time, and you need to auction your time off to the highest bidder, the highest yield.
Powerful.
Yeah. So, yeah.
Absolutely. Martin, anything you feel I haven't asked you that is also important for this conversation that you would like to add?
I would like to add that whether or not you're in the digital business or you're in the physical business, make certain you got there for a reason, and it's your business. You should be proud of it. But don't be so proud of where you are that you forget of where you want to be. Balance that, be mindful, be present. And, sometimes, what is rich today will be cheap tomorrow and vice versa. So it may be that, I'm back here in a month and then say, you know what, I was wrong. These people have bid up brick and mortar businesses like crazy. and that's okay. So just be fluid, right? Don't label yourself one way or another. Look for the opportunity to buy the greatest growth.
Wow, so powerful, so powerful. So, well, thank you so much, Martin. This was great. Where can people go to reach out and learn more about you?
They can go to my website, which is martinpriest.us. That's the most direct way to get there. I don't even know what's on the website right now, but yeah, you can get more information about me from there. Just I also have like a social media thing or something like that, but really just go to my website and see what's there today. And just try and think about everyone should be thinking about how do we really have our own thing. So it's martinpriest.us, not .com. Someone in the UK is a lot faster than me, I guess.
I saw it. Yeah, absolutely. So yeah, and guys, whoever is watching, mention Armand for a special bonus. That's all I'm gonna say. We've been talking about this before this. Mention it whenever you talk to Martin, and we'll have something special for you. Okay. Thank you so much, Martin, again for your time, and we'll see you guys soon. Bye.
All right. See you later, Armand. This is fun.